right.
All right.
You know, it's actually one of my daughter's favorite songs. I've taught her to headbang to AC/DC. It's fantastic.
And how old is your daughter?
She'll be 3 June 1st.
See that? I like that. He teaches her.
If you want a video, I'll happily share it with any of you. She's adorable.
So one of the weird facts about me is I don't like music. I don't listen to music. I don't listen to music in the car, and I haven't listened to music since about 1992. It's about the last time I did. But AC/DC, when it's on, I'm like, I feel this, I understand this. That's about it. All right, we're going to be doing a class tonight on a big problem in the industry. Anthony DiIulio with Wheeler, DiIulio, and
Barnaby.
He's the problem?
He's becoming a perennial favorite. I'm afraid he's going to take my job on the night class. I am Bill Underkoffler, the director of Adjusting at Metro. One of the things about this class that we're going to do tonight is a real challenge with the industry. It's been growing. There's a lot of people addressing it and working with it as well. The United Policyholders are working on it. Tony is actually working on it with counsel, as counsel, with counsel on the problem. And the problem is only getting bigger. Well, Metro Public Adjustment might be the only public adjusting firm out there that actually tries to preempt the problem with their clients by discussing these gaps. So we're going to tell you about where the policies are going, what some of those gaps may be, and mostly the bigger gaps. On the other side, we have been preparing those policy gap coverage review forms for you. I believe we're up to 5 or 6 policies now. We have almost 200 still to do, but another one was put up on Friday before convention. The policy coverage gap review forms are cheat sheets to be used by claim reps and adjusters alike. So when you go in to review a policy and you have that form, you say, okay, let's look for the big problems. And the review forms were laid out to show what those big problems are. So we pick the top big problems and we check the policy off. We say it's average, it's good, it's highly restrictive for appraisal, it's got anti-matching language, it has percentage deductibles, and then in that same review form, if we have it available, we show the form numbers that are there. Anthony, I like to call him Anthony because he's like my younger son, he's so young, actually does a lunch.
Yeah, so it's a lunch and learn session that we've been doing. We started a couple months back. It's live once a month. And the whole goal of these lunch and learns is to talk about issues within the industry that you guys are seeing on a day-to-day basis to try and figure out how to attack them to make sure that the carriers don't get away with the stuff that they're doing. So we've gotten an entire lunch and learn on the appraisal process, what to do when the insurance companies deny or refuse going to appraisal. We've got a class all about estoppel and how to get the insurance company to be held accountable for telling you something in the field and then doing something else different after the fact. These lunch and learns, they're completely free, cost you nothing, and they're also recorded so you can get access to them whenever you want. You can go back to our Facebook page or our website and click the links to watch those videos. You can, I would highly recommend checking these out whenever you get a free chance, and if you can do it live, you get access to me live, which means you get any of your questions about claims answered. Submitting questions, we go through all of them from all of the adjusters. It's really, really great information. We've been increasing our average. We're over 40 people live in the last session. The number of views was well into the high hundreds now. So, check those out if you've got an opportunity to.
All right, so we did get our clicker fixed while you spoke. That was great.
Yeah. That's what I do. I fill the time. I fill the gap.
There you go. Fill the gap. I like that. It's very quick. Very quick.
Right. Quick on my feet.
So coverage gaps aren't really a 2021 issue. They're just really becoming prominent now. You need to understand that what people think they have as insurance is not what they used to have, and it's certainly not what they think they have.
Just to jump in real quick, I mentioned this to my class earlier today, the class actions, but it's important enough that I want everyone to understand this. There has been no issue within the entire country that I can think of where there has been a more successful and longer running disinformation campaign ever. Insurance companies for the past 30 years have been trying to sell people that they are on their side, that they are good neighbors. We know that is not the case. And that disinformation campaign is unmatched. I couldn't think of something better or longer that has been running. So our goal in this industry is to point out why that's not true. why Farmers doesn't know what the heck they're talking about and doesn't cover these claims just because they've seen a thing or two doesn't mean they know a thing or two.
One of my favorite commercials currently, which is really driving this issue, is Liberty Mutual. Only get what you need. You'll never understand what you need because you've never had that claim before. Why would you purchase that insurance? That's another thing driving this. You know, being premium conscious, there was it the Progressive Name Your Own Price tool?
Yep.
So Progressive had the Name Your Own Price tool with homeowners insurance, and basically you would reduce your coverage to continually reduce your premium. But what they would do is you would pick an item to reduce, and it automatically behind the scenes took away another coverage. That was like a package. You just removed that one and it removed sump pump coverage. Got rid of this one, it was now a required opening. If insurance companies got rid of required openings, they got rid of backup sewer and drain, and they added required openings, got rid of backup sewer and drain, got rid of replacement cost coverage, went to ACV coverage, they'd save almost 50% on every claim. The premium was dropping by like 20%. On top of that, with the deductibles, I've done deductible math, where if you increase your deductible from $1,000 to $2,500, it takes 19 years to get the money back. That means you can't have a claim for 19 years before you get back the money you saved if you would have had a claim in the next 19 years. Average claim period is a little over 7. So they're actually making almost triple on your increased deductible reduced premium. All right, let's talk about a couple of the big, we can probably stay on this slide all night because we don't need pictures. Does everybody in here know what a roof schedule is?
Better question, does anyone not know what a roof schedule is? Raise your hand, be honest, it's okay.
That's good. We'd rather you not know because we could just go, if you all know, why don't you come up here and
Right,
we
right,
could sit over there.
I'm out,
sit
guys,
on that
take care.
side.
Have a good one.
All right, so I'm going to start with the roof schedule. Anthony's going to correct me when I'm wrong. So a roof schedule is a predetermined fixed depreciation chart for roofing based on its age only. No factors including condition, no factors in considering, there is 2 tables, one for kind of lifetime tabs and one for sub 30-year tabs. But these are straight line depreciation tables that range anywhere from 5 to, I've seen 75%. Have you seen worse?
80 was the worst I saw.
80 was the worst you've seen. So let's take an example of an 80% roof schedule, which is probably at the 20 or 25-year mark.
Yeah, 25 years, 80%.
Okay, so 25-year tab. Now, I can tell you right now that Metro, doing, say, 10,000 claims in a year. At 10,000 claims, I'm willing to bet that 3,000 of the roof claims we do involve roofs over 25 years old.
Yeah.
So as roofs get older, they get brittle and they're susceptible to wind damage. That's the model. That's what happens when they blow off. Your insurance covers it. So I take that roof schedule and apply that to my loss. These are non-recoverable roof schedules. So now take that roof, and let's take a standard $500,000 home and a $30,000 roof. And you have a $2,500 deductible. No interior water damage. They agree the entire roof should be replaced based on the damage to the roof from the wind. We have $30,000. We meet the 80% criteria. That means our roof is going to pay 20%, $6,000. We have a $2,500 deductible. That's going to leave an ACV check of $3,500 for $30,000 in damage. That's what's out there. That's what they're doing. That's built into policies. And all it says on the deck page is roof schedule.
And the problem is,
it doesn't say no roof coverage. It says roof schedule, and it gets worse. Anything on roof?
well, yeah, on the roof issue, the problem that they're really having here when it comes to the insureds is they have no idea that these are getting slipped into their policies. So we are having these clients who are getting a new policy from their agents and say, oh, I can save you some money here. Here's a cheaper policy. It's got the same coverages, so don't worry about it. They have no idea that they've got this roof schedule, which is one of the few items in your house. Something bad is going to happen to your roof. Something's going to go wrong, and they have no idea that they're reducing the amount of coverages that they have. Sure, absolutely. If the agent makes a representation that it's the same because they don't know what they're talking about, that would be an E&O claim all day long. And then if the carrier slips it into a current policy and doesn't provide proper notice or doesn't give consideration, meaning they don't reduce your premium by some degree because they're reducing your coverage, they're going to be responsible for those payments. They cannot just unilaterally change your policy without giving something back to the property owner, even if it's pennies. Even if the premium were to reduce by pennies, the carrier has to be able to substantiate that change with some form of consideration.
So generally, the deck page may contain the age of the roof. That is an underwriting criteria. It does not mean the policy contains a roof schedule, but it does alert me to look for a potential roof schedule or built-in roof schedule language. I sold my first policy the other day without a roof schedule built in, without a roof schedule endorsement. It was actually built into the policy.
Wow.
So it is starting to become more mainstream. So let me ask you this. Single-family homes, how many people here actually know how old the roof is? How many people don't know how old the roof is? How many people don't know? All right, first of all, I opened my freezer the other day, and the ground turkey was dated 2013. I'm not kidding you. I'm not kidding you. It looked fine, tastes like turkey, but it was 2013, okay? So my guess is your roof could be older than you think, or you may not know your actual roof. So you look at that schedule and probably don't understand it. It's a big spreadsheet sort of grid. You probably don't understand what it says for the most part. All right, we're going to move on. Yep.
What policies do you know for a fact that have all the roofs? I know all states noted for it. What other policies?
I don't know them off the top of my head, but I am, as I review them, I post them. But there's a lot out there now. Roof schedules are becoming more and more common. I don't have that list. All right, let's go to percentage deductibles. And hold on, though. We are going to then add the complications of each gap on top of each other and explain how that will work. So percentage deductibles started coming out. I think State Farm was the first one to try it, correct?
I believe
Besides
that.
wind hail.
Right.
State Farm came out with the percentage deductible on all peril losses, meaning other than wind hail as well. And if I told you that I'll pay for 99.5% of your loss and you pay the other 0.5%, does that sound fair? It really
Sure.
does.
Sounds great.
But it actually isn't how it works. So the multiplier, the 0.5%, gets multiplied not against your loss, against how much?
The entire policy amount.
It gets applied to
coverage
the
A.
coverage amount.
Yeah, all coverage A, all whatever
So
it may be.
0.5% is a relatively high number when you're talking about a $500,000 policy. Right now we're at $2,500. But it's not 0.5% that's the real bad one, is
Right.
it?
No.
It's
no.
the 2s and the 5s.
Yep.
So let's just take a State Farm policy, $500,000 with a roof schedule built in. $30,000 roof, $500,000 house, now I have a 5% deductible. I have a 5% deductible, it seems fair. They saved me $70 a year, by the way, for that. Going from $1,000 to a 5%er. And a 5% deductible on $500,000 coverage A, run the math, doodle it back and forth, that's 25 grand. So if the average loss in America is $7,000 without a public adjuster, and you have a $25,000 deductible, you bought a policy that will never pay for an average loss at all, so you basically took your homeowner policy and said, I don't ever want to use it for an average loss. $25,000 and higher is about 10% of losses. So basically you took your policy, you took a 5% deductible, and you said 90% of the time, I cannot use my policy. That's what that deductible does. Anthony.
Now, with these percentage deductibles, it's becoming a bigger problem because they are being added into the average claim. But you still need to watch out with them for the wind hail claims on these properties. Because what carriers have started doing, and we're starting to actually build some large claims against them because of it, they've started to try and trigger these wind hail deductibles simply because something happened during a storm, despite the storm not being the cause of the damage. So they say, oh, well, there was a storm. It's a property on the shore in New Jersey. Storm comes through. Rainwater gets into your property, triggering your wind hail deductible. And we all go, what are you talking about? We're not claiming any wind or hail damage. This is simply ensuing loss from the water. That's all we're asking for here. There's no wind or hail deductible for this. It goes back to the 1,000. And they have been universally saying, nope, we're trying to do it. We're going to try and take that full amount. Make sure you understand why they are trying to trigger it so you can push back and tell them there's nothing that we are claiming that's wind hail related, so you can't use that deductible.
So Anthony's example, to use the reverse example, when the policy requires a wind-created opening for coverage, you have to prove wind exists. When the policy does not require that opening and there is no physical claim to the exterior of the building, we actually have an all-risk claim at that point. we don't have a wind claim. Even though it's reported as wind rain normally, the loss is actually paid under the all-risk peril because wind rain wouldn't be covered without the required opening. So if it's being paid under the all-risk ensuing damage provision, they can't apply the named peril wind deductible.
Correct.
And they do it every time.
And think about, I want you to understand why this is so important. It's the same reason frozen pipe claims shouldn't always be called frozen pipes. You might want to say, well, look, I could get a slope of the roof. Maybe there's a little bit of damage up there. I can figure something out. Maybe it's worth it. But maybe that one slope of the roof that you're going to push for, $2,500, $3,000, $5,000, if you've got a wind deductible that's $25,000, you're triggering simply to try and get $5,000 more, that's a mistake. Leave it out. Do the math beforehand before you present the claim to know that you are maximizing this value for the insured.
Excellent point, excellent point. Now, we'll go back to that State Farm claim. We have our $25,000 5% deductible. Let's take it down to a 2%. Let's just go to 2%. State Farm, $500,000, 2% deductible. I would say that's not an uncommon policy. No. I see that quite a bit. So now my deductible is $10,000. Let's just say my roof schedule in there and I'm at 50% depreciation. I have a $30,000 roof, 50% off the top is $15,000, $10,000 deductible. Again, I get $5,000 for a $30,000 roof. If I had that 75% depreciation, zero. So once my roof hits 20 or 24 years old, whatever that maximum number is on their chart, I've basically eliminated my full roof coverage. Mark Jacoby, you in the room? Yeah. Mark has a claim right now, or a policy, I don't know if it's a claim, with multiple buildings. All of the buildings contain a specific deductible for each loss. So if a large storm comes in and hurts 5 buildings, each building carries a deductible. Each roof in that building, I'll make this up to make the story fast, each roof in that property is worth about $40,000. They have a percentage deductible that will allow for no coverage for each one of those buildings. So technically, if a storm came in and blew off every roof in there, there'd be zero payment, correct, Mark? That was what I ran into. Yep. So the wind deductible, the way it's applied, or the percentage deductible, the way it's applied in that loss, would literally eliminate all roof coverage. You actually have a mortgage on a lot of properties. Most people do. I'm too old to have a mortgage anymore. So if you do have a mortgage, your mortgage company has a requirement for coverage.
Correct.
Now this is a new phenomenon. This is probably why the coverage gap sort of thing started getting some traction, because your mortgage has a minimum requirement for the amount of insurance required on your property. Some of these deductibles exceed the minimum requirement of coverage available on the property, and therefore if you actually look at your mortgage document, the bank actually has to make good, and the insurance company has to make good on that percentage deductible difference because it violated the mortgage. So the bank is on the hook. If they allowed you to have that policy and they didn't understand it, technically the bank is responsible for the difference between the minimum required and what you had. That's a tough adjusting issue, but it is possible, and we do see it. I'm aware of it.
You know, it's come up in all the starting slides about Appia and joining it and what good they do. One of the things that we've been doing at Appia is to actually sit down with these mortgage companies to make them aware of this problem. They had no idea. They didn't realize that Farmers changed the water coverage to in essence, named peril storm-created opening provision. It was against the policies of Fannie Mae and Freddie Mac to allow that policy to actually be issued under one of them because they required the all-risk HO3 language.
Fannie Mae and Freddie Mac being the person who actually holds most mortgages, by the way.
Correct. So once we notified them of this, and I've spoken to legal counsel myself for both of them, they are in a position where they want to sit down and actually get a list together of these companies that have roof schedules, that have these changes within the policy that in essence alter the form from an HO3 to a named peril HO2, and stop issuing the mortgages, stop allowing them to get those policies. This could be huge for the industry if you have to buy a house and you're getting any kind of loan that is involving Freddie Mac or Fannie Mae, and they say, Farmers, sorry, can't have it. That's going to crush some of these companies a large amount.
So yeah, well, it's funny because they don't care about claimants, but they care about themselves, and that's pretty much the way to solve all negotiations. Hey, first rule, if you go to my negotiation class, first rule in negotiation, people do things for themselves, not others. So learn how to find out who it's going to help, have them help you get that problem solved. All right, so percentage deductibles can apply to either the wind rain hail, or they can apply to all losses. Be very, very careful if you see a percentage listed. State Farm must have gotten sued because they actually started changing it from the percentage, and then they would list what that actually is below.
Yep.
And I saw that show up, and I'm guessing they got hit a few times.
So what
on
actually
that.
happened, what happened with that is they were sued because what they were being sold was it was going to be a percentage of the loss. That in essence, when they were buying these policies, they thought, oh, it's 5% of my loss that they are going to be hitting me for the deductible, not 5% of the entire policy coverage. So that's what the issue
Half
was.
of America can't do 5% of $500,000 without a calculator. So they're looking at that, they have no idea what that actual number is. All right, that's two. We've went over two common gaps in coverage. Let's go to GRC qualifications. So guaranteed replacement cost was actually brought out from the large losses in California in the 90s. So what was it the fires or?
I was still watching DuckTales at the time, Bill, so I don't know.
He was watching Nickelodeon. So somewhere back in 94, 95, there was large losses in California. I don't remember the actual storm itself.
Cedar Crest Fire.
What was it?
Cedar Crest Fire.
Cedar Crest fires.
That's what it was. I'll take your word for it. So I honestly don't remember, so if that's it. So State Farm realized that they had not cleaned up their database of policyholders in years. And they had all these fires occur and total losses, and most of these homes were underinsured drastically. I mean, to the point of hundreds of percent. House was $1 million to rebuild, and they had $250,000 in coverage. So State Farm was in this position of all of their insureds were drastically underinsured. No one had enough money to rebuild their homes. And somewhere the state got involved, and basically they all agreed to come out with, better underwriting criteria. They actually came out with a calculus to decide the replacement cost of a house based on how many corners the foundation had. But they added this endorsement called a guaranteed replacement cost endorsement, which basically is, I'll fix it if we made a mistake. And the endorsements came out, it's actually, in State Farm's case, it's actually called Option ID, Option Increased Dwelling. And what that does is it takes your coverage A and says, in the event of a total loss, we will allow for an additional percentage of coverage over that. 20%, 25%, 50%, and a true GRC policy says unlimited. A true GRC policy says even if we insured you for $500,000, you'll see there'll be no coverage A listed, but there'll be a B and a C, and you'll realize they're a percentage of what they think the house is worth, right? So maybe there'll be a 300 and 270 for the other coverages. So you're like, it's probably around $500,000, but it'll say GRC, and that actually means that they will pay you an unlimited amount of money if the value of the rebuild can be documented to that amount, true GRC. So here's what they've done with the GRC endorsement. You know where I'm going or not?
No.
Okay. So
You lost me.
I wrote the class. Tony's up here as my sideshow color person for an expert commentary. And of course, so he looks good. What can I tell you? Makes me look older. That's all. I get up here, I'm like, Jesus, how old are you?
35.
Oh my God, my son's older than him.
Yeah. I make Bill look old and short. So it's a
My
nice
son is
combination.
older than him. But I'm not going to use my age and experience against him, okay? All right. So GRC qualifications is written into the policy. I've yet to find one that doesn't have the language.
Oh, the 5,000. You're
Yes.
talking about the 5,000. Oh, I did know where he was
I
going.
knew
Damn it.
it took you a minute. He was a little slower, but he's catching up. All right. So it says inside of every single one of these policies that contain this great additional coverage endorsement, it's a wonderful endorsement. It says that if you've made a substantial improvement to the property, and we talked about it yesterday
Yeah.
as well, that's why. So it says if you make a substantial improvement to the property and don't notify them either before or slightly after you made that improvement, this endorsement is gone. So most of these policies say more than $5,000. Does anyone realize how little that is? In a cumulative amount of repairs that would increase the replacement cost of the building in a policy period. So what do you think during Corona, with every building material and appliance being sold out across America, that people improved their houses by more than $5,000? It's a big
Guaranteed.
number. It's a big
Guaranteed.
percentage. In fact, the farmers policy, which we went over yesterday, actually said you must notify them 60 days prior to doing any repair in your house. Prior. I don't know what I'm wearing to work tomorrow, yet alone give me 60 days notice before I decide to change the countertops, right? So these endorsements now have this pullback. they've gotten hit really hard on these endorsements.
Yep.
I actually had a full GRC endorsement on other structure. The other structure was insured for $90,000. We settled it for $450. There was no limit to it. Granted, it is an incurred coverage. You had to actually sign to do the work to get over the policy limit, but we did get the coverage. So the GRC qualification clawback, as a policy review option, you need to ask one question of every single review. Have you done any substantial repairs in your property in the last 12 months? And if they have, you can point out that this great endorsement, this great additional coverage they have, most likely does not exist, and to immediately contact their agent and let them know what they did. Now, if they just swapped out something, you can do this one.
Right. So yeah, if they're just swapping out, a tile floor, they don't like the tile floor. Now they've got a new one. That new tile floor costs more than the one they put in 25, 30 years ago, but it's still a tile floor. It's still ceramic. It's just nicer, newer. That's not going to have the same effect as if they're changing from, a laminate countertop to granite countertops, or if they're upgrading their appliances from an electric range to a nice Viking, gas stove. Those types of differences are the ones you want to look for. Simply just improving an item that is already there, redoing your carpet, those types of things aren't necessarily going to be enough, and it's something that you can push back on. The other big thing with these percentage deductibles that I want to make sure everyone's aware of, because this comes up with a lot of my claims. Because there isn't a limit listed within the policy, I've had total losses that have come into my office where the insurance company has said, look, it's a total loss value, let's say $150,000. And the adjuster writes a loss for $350,000. We've got $200,000 in dispute. And there's a lot of times I could make the argument, if there is a policy limit, well, look, you insured the property for X, you were taking your premium for that amount, you're going to be held accountable for that. That argument still works with these GRC policies because they still list what they are estimating the total value of the policy for, because that's how they have to base their premium. You will not have a premium that's not based off of whatever their estimated number is. So make sure that when you're doing these policy reviews, you point that out to the insureds, or during the loss, make sure you note what that is, because you can go back to the carrier and say, hold on a second. You cannot come in here and say this was a total loss. It only cost $150,000, but you were taking a premium on a replacement cost of $350,000, estimated, by the way, by you. This was your number that you put in the policy at $350,000, not me. They're going to have to be held accountable for that.
You can, if it doesn't list that on the top line, you can get to it by looking at the other multiple factors. So you'll see the subsequent coverages,
Yep.
but there is an original starting point for coverage A, even though it may not be listed on the coverage A line. It's pretty easy to figure out with the other coverages. All right, so that's 3. Now, Anthony actually did one of the great access claims that we'll talk about here. And access limitations are drastic, number one. They can be devastating financially. If you have a percentage deductible and an access loss for, say, a pipe buried underneath your ceramic tile floor in the kitchen and your toilet overflowed, I can tell you right now that that game has changed. This is not the old backhoe cutting up the kitchen floor, putting down the pipe, repairing the tile floor, and everybody gets paid except for a little bit of dirt that got moved. This is a very serious restriction in so many policies today. It's a $10,000 to $15,000 normal claim to access and to repair a pipe that runs underneath the slab of somebody's home. That's normal. Plus carpet, plus tile, plus cabinets, whatever that is. But just the plumbing repairs are between $8,000 and $10,000. If the plumbing's not covered, it was about $2,000 of it. So you're spending $2,000 on unrepaired, and the insurance company would pay 80% of that bill, approximately, not strictly 80%. I'm saying that's how the real world worked. Anthony, what have they done to these access limitation provisions? And you have a really nice 7-figure one to talk about.
Yeah, so State Farm is one of the biggest culprits here. They've taken their policy and they've said, we used to pay to access that system for which the water escaped. Whatever repair is necessary, we pay to access it. Obviously, we all know that they don't pay for the pipe itself. And that was always the case. And then State Farm comes out with a new endorsement that they throw in that says, we're only going to pay to access that specific point of the system for which the water escaped. So, easiest question of the night. You get a toilet overflow case. Where did the water escape from? The toilet. So you get access to the toilet.
Where's the break in the pipe?
underneath the slab. You can't get access to that slab under State Farm's theory with this new provision. It is an unbelievable hindrance to what, again, is going to be a near guaranteed loss at some point in some person's home. They are going to have their sewer line break. It's going to happen.
Anthony, real quick, I read the endorsement 4 times. I still didn't understand it.
Nope.
Because I couldn't come up with, how would you ever have access if you only owed to the point where it came out if you had a toilet? And I sat there, I read, I called him. And he's assuming I understand what it means. I'm like, I just don't get this. I just don't get this. It finally clicked. And I'm like, are you kidding me? It's an impossible provision.
Correct. So what had happened, I talked about this again briefly in my class, they sent out this endorsement with a provision that says, we are not intending to reduce your coverage. We're not intending to change your coverage. That's the first line of it. And then it says, however, depending on how this is interpreted, we may be reducing or eliminating your coverage, so you should take it as an elimination or reduction of coverage. Then, here's the real kicker, they call it additional coverage in the endorsement. So they've now in one page, said they're not intending to change anything, but depending on some mysterious person who might interpret it, we might be eliminating your coverage, but by the way, here's some additional coverage that wasn't in there before. It's absolutely absurd. So we took this to court, and we proved to the judge that this endorsement was clearly unconscionable, that it was misleading, and we got a bad faith verdict against State Farm for trying to enforce this provision that they never notified the insured of properly, and that they in fact tried to mislead the insured by making this statement that they weren't intending to reduce coverage. We have now 6 depositions on the record of State Farm admitting this is a reduction of coverage, and we've got a class action going against them because of it.
So, that's a monster, by the way. That's a monster. All right, so yesterday we talked about, there's about 20 of these out there that reduce this coverage. So most of this is concrete cutting, access through concrete, and the farmers. You can always say, and the farmers, because it's just always the farmers. And the farmers policy actually has a $2,000 limitation for concrete, for access through concrete. They call it their tunneling access limitation. So if you have to cut through foundation, cut through slab, they limit that access to $2,000. What did I say the access costs on an average claim? $8,000 is covered, $10,000 is the job, correct. So they limit it to $2,000. What do you think the odds that we have more than $2,000 with access? Complete limitation in coverage.
I don't think I've ever seen access less than 2,000.
I've never seen it.
Really.
I've seen where like they've cut up like a J channel or an elbow underneath of a toilet, but I've never seen where they actually had to cut a line be under about $6,000 or $7,000.
Yep.
All right, so now we have an access limitation which affects every home in Levittown, every home on slab. Eventually, it will affect any home with slab because supply lines are underneath the slab, drain lines are underneath the slab. So when they break, that's where you got to go to fix them.
So let me give you the trick real quick in case anybody doesn't know, and I think I've talked about this a few times in the past, but I want everyone in this room to understand there is a way around this, even under State Farm's interpretation. All you need to do is get a plumber to come out and say, as a result of the broken pipe underneath the ground, water was escaping. Period. That's it. It does not, under this policy, need to be the water that damaged the home. Let me stress that again. The water that escapes the pipe that triggers this coverage, once you have a covered loss, once you have damage inside your home, the access coverage does not need to be triggered by the water that actually causes the damage to your home. That's not in the policy. It's clearly an oversight from State Farm's position, but if they're going to make an oversight, we're going to take advantage of it.
So remember the language when he stated it? It says from the location of which that water escaped.
Right. It never ties it back to being the damage.
To being the cause of loss.
Correct.
So most policies that are more liberal allow for access to where the escape was, which is the location or wherever the escape was, as long as it affected coverage A building property. This policy actually says from where the water escaped. So if you access it and repair it first and the plumber says that's where it escaped, which is on the middle of the living room floor, that provision actually does not apply the way we read it.
Correct. So again, yes, water escapes from the toilet. You've got damage to the home. Coverage is triggered. Now you've got to figure out how much coverage do you have. You go to the access provision and say, we'll pay for access for wherever the water escaped. They do not say that's the same water. So you've got the plumber report that says water escapes from the drain line. You show that to State Farm. Now you've got your coverage. If you've got questions about how that plays out, let me know after this. The plumber needs to write in the bill that the water not only escapes from the toilet, that's fine, but the water was escaping from the drain underneath the slab. If water is escaping that line, it doesn't have to damage the property. It just needs to be escaping the line. And by the way, any line that collapses, any line that's got a break somewhere, water's going to be coming out. So as long as the plumber writes that, you're going to get the trigger.
It does.
Agents from State Farm have been saying, well, this is to stop the exploratory plumbers, they poke a hole here, a hole there, to find so that they don't pay for all that.
We haven't had an exploratory plumber problem since the invention of scoping and video cameras now. They don't make holes. That's just, they're making that up. They don't know what they're talking about. They were probably told that by their sales manager, which again, it's a bunch of sales BS, but that has nothing to do with reality. It was put in for the exact reason that we talked about, to eliminate access claims in slabs.
They want to not pay. Sure, but again, that's really not why they're getting at this. They know what these claims are being paid out.
We've done thousands of these claims. That's never been the issue.
Yeah.
Mark?
Run into some problems suggesting what other contractors write with regard to a loss? I mean,
No. You can run into problems dictating language to a contractor. You cannot run into problems when you tell a contractor that they need to focus their report on this event and just be clear that State Farm needs to know where the water escaped. Can you put that in your report? You just can't say you need to write this. It had to have happened, number one, but you need to tell them they're not looking for a regular access report. They're not looking for your hours. They're looking for a report that says that the water was escaping at this point in the pipe. Just ask them to re-clarify that, and that will solve that problem.
Always.
the other objection I come up with coming up with this with Liberty, with Nationwide. Nationwide's telling me that the access is, they're saying that the land isn't covered. And I keep saying I'm not claiming the land, I'm claiming access to fix the blockage in a sewer lateral. And it's on their property, right? But they're saying, no, we don't cover land.
Are you talking, so the question is access to land, are you talking inside the property or outside?
Creating so that you can get to a sewer lateral, right? And so that's access, and therefore the backhoe and the access to that pipe should be covered. However, the pipe should not be covered.
Are you referring to inside the building envelope or outside?
I'm talking outside the building in the yard, but still I'm squarely on the property.
Anthony?
Now, they're writing in distinctions about that. They are starting to write distinctions. It has to be under the actual dwelling.
Right, right.
This one doesn't have that, but they're
So I can tell you the normal language that restricts that is the definition of residence premises.
Correct.
And the definition of residence premises is that outer perimeter wall in. Therefore, when they do exclude land, land's not fully excluded, by the way. It's only fully excluded under coverage A losses. Land has full coverage for liability and other things, but they exclude coverage beyond the walls of the residence premises. That's pretty much where they're getting out of the exterior access.
Yeah. Agreed. 100%.
All right. So reclassification by definition, and this one's starting to creep a few more policies as well. I believe farmers is the plow here. They're plowing the road for being the most obnoxious. But you are starting to see definitions in State Farm and Allstate, and I think they're reading the farmer's policy and saying, I think they got game going on here.
Yeah, Farmers is, look, if anyone doesn't know, Farmers leading the way when it comes to these policy changes to test the waters. They are the guinea pig for these carriers, and they are all going back and looking at the policy and figuring out, Farmers got away with X, Y, and Z things, we're going to do it now.
So one of the big reclassification by definition is by changing common items. So if you take the definition of marring, we'll say, now includes cracking, scorching, denning, gouging, creasing,
Staining.
I know it's almost a dozen things, correct? Instead of marring, which was undefined. So they reclassified most normal losses, a dent in siding, crack to flooring, cracked tile. We have went to impact damage because impact is not written in that definition. But look at how they redefined plumbing. They got rid of the shower pan as a plumbing device because the access provision in a policy allows for access to broken plumbing which the broken plumbing of a shower pan, which was part of the plumbing system, was to go through the tile, replace the walls in the shower, the tile bed in the shower, maybe the floor of the bathroom to get to the broken pan. The pan wasn't covered because it was a plumbing device. What they have done is classified the shower pan as a non-plumbing item, therefore access does not apply. Well, who looked at that? Who even understood that by saying, well, a shower pan, it could be anything, I guess, right? The regulator doesn't understand that a shower pan was an integral part of the plumbing system, which then triggers access coverage for failed plumbing, is no longer going to be covered under that provision. Shower pans, probably, it's a big number.
Oh, yeah.
It's 10, 15% of losses.
They're targeting, carriers are targeting with all of these restrictive endorsements, they're targeting the areas that they're seeing most often and trying to figure out what can we do to pay less of these claims. This isn't rocket science. They know that their biggest losses that they can ultimately restrict for what they pick at is one small issue that creates a large number. That's what they're looking for. So they say, oh, you've got one drain line that's damaged, but all of a sudden you've got a $40,000 access bill. We don't like that. So as a result, we're not paying you the access. We don't like that a shower pan can break and cause $40,000 bathroom to have to be redone, so we're going to limit that restriction. One of the things you've got to remember is that everybody before a loss, every person that is involved with getting this homeowner insurance, from the day the policy is first written by the insurance company to when it's sent over to the insurance department for review, and I use that term in quotes in purpose because they don't actually look at them, to the agent who sells them, none of these people are actually looking out for the best interest of the homeowner. They are either financially interested in getting the policies bought, or they are too swamped to care. So you are the first line of defense for these property owners when you get called out to a loss to say, look, this is what we need to do. Or when you do your policy review, talk to them. And if you can prove that you have this knowledge, that you are the one that cares, that's the stuff that keeps these customers coming back, the stuff that gets your name sent out to all their friends, families, and otherwise.
So reasonable and overly broad definitions. Overly broad definition is the word reasonable. I've seen the replacement cost minus depreciation equals actual cash value. It now says the reasonable replacement cost. Instead of we owe for the direct cost to mitigate and protect the property, save your receipts, it says we owe for the reasonable cost to do so. Once you add the word reasonable, you've turned the definition into an argument. Because now we have to decide who's reasonable, you or me. If you've ever been to the table at a divorce, you understand that there's two sides. Both people think they're being reasonable. Both people on the other side feel the other is being completely unreasonable. It's difficult to get agreements if the word is reasonable because it seems reasonable to one and it doesn't seem reasonable to another. And they've created this by adding them to definitions of coverage. I'm going to give you my favorite one, is the appraisal provision in the farmer's policy. The appraisal provision in the standard policy says if you and I fail to agree on the amount of a loss, you and I may choose an appraisal at our own expense, pick an umpire for an expense to be shared equally, those two to set the amount of the loss equally, to set that amount, if unable to agree, use an umpire, blah, blah, blah. Right. Substantially what an appraisal provision says.
About one paragraph.
That's pretty close, right? The definition of appraisal, the provision of appraisal is 2.5 pages?
Yep.
2.5 pages long. In that provision, it states that each appraiser must disclose every loss ever appraised with the other appraiser. They don't even keep those records.
Nope.
It says that you have to disclose if you know something. It says you can't guess at a number. It says you have to provide backup to your data. It has this list of ridiculous things.
It also tries to make it a prerequisite to suit.
Exactly. And it says you must use the appraisal provision before exercising any of the options of settlement on this policy.
And then they come back and say, after all this is done, we can still deny the claim.
We can change the values that the appraiser sets.
What?
So on top of that, it's this impossible list of criteria. So if you ever had a really big project and you got it all together and you kind of cut a corner here and you got this done, but you put it all together and it looks done. And it says, substantial compliance with this provision does not satisfy this provision. Meaning, if you did most of it right, it's still wrong. It's unbelievable. And we've had some appraisals come back, and the appraisal award comes in at $25,000, signed by both appraisers. Estimates are supported, and they say, no, we're not paying any more money. The appraisers didn't justify their position. It's not. The purpose of appraisal is to get rid of them, the insurance company, making the justification and throwing that justification onto the appraisers, and they're saying, no, we're still not paying it based on our provision.
So real quick off of the appraisal issue, if you get a chance, I really do recommend watching the appraisal lunch and learn that we have on the website. It goes through some great stuff, but I want you guys to know something. The appraisers can't just do anything they want. And we've been seeing a strong, strong push from some of the same consistent appraisers that are working for these insurance companies that are causing problems. They've been doing things like not writing any estimates and immediately demanding it go to an umpire. I've got a great one that just came in with one of you that says they agreed to a contractor to come out to determine if cabinets were repairable or replaceable, and everyone would be bound by it. The contractor was chosen by the opposing appraiser and says that the cabinets have to be replaced. They cannot be repaired. The opposing appraiser says, nope, I'm just going to put in for a repair, and if you don't like it, send it to an umpire. Just because it's an appraisal doesn't mean you can't file suit. And we have been bringing the claims directly against the carrier and the opposing appraiser. It is a wake-up call. And from what I'm hearing, it's actually working. Some of these appraisers are actually understanding that they're not going to continue getting away with being unreasonable. And
Davis Race.
I've got no secrets here. Dave Strace, we've got cases against. Greg Smith, we've got cases against. And John McHenry, we've got cases against. And anybody in this room that knows any one of those three people knows why we're
They're all the exact same person in 3 different bodies. And they have an uncle, and his name is Satan.
Yeah, right. Yeah.
Uncle Satan. Yeah, well, that's Satan himself.
Yeah, right. And from what I understand, they actually all share office. They all have this. They work in the same building, and all talk about this as it's happened. It's
John McHenry is actually a personal friend of mine.
Oh.
But I am fully aware of his tactics.
So, long story short is if something happens during your appraisal where they do something like they underwrite what the carrier's already written. Carrier already said 8,000 is coming to you. Dave Strace comes in and says, no, I think it's 6,500. They can't do that. They can't reduce coverage that's already been offered to you. We filed suit and we've been successful with that. If they try and force it straight to the umpire without an estimate, they can't do that. It only goes to an umpire if there's a disagreement and the two appraisers can't agree to the amount of the loss. They have to do their job. That's it. We're not asking for the moon and the stars. Just do your job. So if you've got those problems, give me a call. Let me know.
Powers, you in here?
I deal with it. I tell the umpire that you can only consider my estimate because he didn't do his job. His job was to actually estimate or decipher what the value was.
Mark's question is, if there is no estimate, you can only use the estimate that exists that is his? Mark is correct.
Yep.
We've actually had where the umpire shows up, says, I only have one estimate. I cannot rule on the other estimate. It is a proper way to settle. The umpire should award you fully in favor. It is true.
And we've also been seeing a lot of empty seat appraisals. Does anyone here use empty seat appraisals? Do they know what that is? It's an opportunity that if the carrier refuses to go to appraisal, say, look, you can't refuse. This isn't a choice. You name your appraiser, that appraiser picks an umpire, you've got two people, you sign an award, send it to the carrier. The amount of the loss is set. Now, we're still going to have to file suit, don't get me wrong, but now you've got the amount set through the appraisal process, and the carrier has a much, much harder time fighting that amount simply because they ignored the provision.
So
It's
Clint
been really
Eastwood
great.
did that at the Republican convention with the chair. What Anthony is saying is you go to appraisal, you meet the umpire, your appraiser, he agrees, it moves on. No one ever represented the insurance company position. They probably won't make the payment, goes to suit, but the amount has been set. It's a really good process.
Great process.
All right,
It's
let me
working great.
do this. This is a roof schedule.
What were the names of those 3 appraisers again, David and Ray?
We're not going to do names here personally. Talk to Chris Powers. They're his best friends. All right, I want to show you this, okay? This is a roof schedule. I have to get up here to read it. But it lists the type of roofing at the top. So a less than 30-year tab. Once it hits 23 years, it's depreciated by 75%. So once this hits 23 years, you're getting 25 cents is the payment, not the depreciation. If you go to a 30-year plus, which is a pretty heavy shingle. They only drop it to 40% of payment, so you lose 60%. Look at Slate. Slate is a 100-year product. They're saying if it hits 30 years, you have a 60% depreciation table. When I tell you that they're wrong, number one, they're way too aggressive. They're more like an IRS table, but these are what are built into these policies, and you go, wait a minute, my slate roof is 85 years old. I've done slate roofs that are 120, and they're in great shape, and they need a minor repair. And in this case, you have no coverage for get a big hailstorm, wipes out, slate roof could be $250,000. All right, so it completely wipes that out. We spoke about the access limitation. We did it verbatim with the headlines, right? We just went over all this stuff. Which policy is this? Building structure next to the gains. This is State Farm's.
This is State Farm's new language. So when State Farm, what they did it with an endorsement originally in 2014, and then by 2019, they actually changed the policy forms itself. I find myself repeating a few things I said in this prior class, but it's important. The reason these carriers don't like to change the policy language normally is because they know what the law says about their old language, don't want a new risk. Well, State Farm tested it out. They've lost on the endorsement against me, so then they've now taken the endorsement away because they took away that language that says, oh, we're not intending to change your coverage, but we're actually maybe taking it away depending on who reads it, and here's additional coverage. I don't have those arguments anymore because what they did as a result of me was just put it straight into the policy. I'm not a miracle worker. I can't change things forever, but we're going to keep fighting this every step of the way to make sure that these carriers are held accountable.
Well, and that is the real value of working closely with attorneys. We're partners, and Anthony is the partner for this event. I was talking to him earlier today. I said I changed the sponsorships, and I called Anthony's level of sponsorship. He's the top sponsor. I called him event partner. And we really do form partnerships. If Anthony doesn't represent our clients, and we don't feed Anthony our claims that we can't resolve, we need to coexist. We need that. Real quick before I'm going to mention here, Fantini.
Oh, yeah.
So Lori Fantini is online. I'm hoping she's watching us or listening. Lori Fantini's niece, Samantha Fantini, I'm sure she wouldn't mind me using her name.
I'm sure.
Has a loss up in western Pennsylvania. She has, who was that, Carrie? Was it Erie?
I think it was, but I can't remember.
She has Erie insurance on her home. So here's the deal. She lives out there in fracking country, and it's a booming town because fracking is going on out there. He's lost his job since they shut down the pipeline. So she lives in this house, and a beautiful home across the street from her with tons of land and outbuildings becomes available.
Their dream home. I mean, this is a family who...
Literally, it is their dream home.
They've seen this property. It finally comes on the market, and they're in a position that they can actually purchase it and get this dream home that they've wanted forever.
They're not people of real means. They take a full mortgage on the property. I'm sure they put a down payment, but they have a big mortgage on the property, and they decide that to move into that property, they're not going to sell their house right away. They're going to renovate it until it's exactly the way they want it. It's basically across the street. It's kind of like...
You can see it from the front yard.
Probably 500-600 yards max, but it's across the road, but you can see it. So they decide to work on this house. They tell the agent and the broker when they buy the policy that they're going to renovate the house and then move in, and they're probably going to rent their house. Well, somewhere along the way, they decide that they're actually going to sell their house, but they keep renovating, and the weekend before they're really ready to move in, the house catches fire. It burns basically to the ground. I get a call from Lori, my niece, and I know Samantha. I've done a claim for her before. My niece has a claim. She's incredibly calm, isn't she?
Yes. Yeah.
She's so sweet on the phone. And I go to the property. I'm like, it's gone. It's gone. It's actually a balloon frame construction. It's gone. Even foundation damage. And all of a sudden, we get the recorded statement. I think it all goes fine. I'm aware of a potential issue because she actually hadn't moved into the property. But all those provisions state that renovation is considered occupancy, except in the farmer's policy.
Yeah, right.
It is not considered vacant if the insured is renovating the property.
It also helped, by the way, that they were there almost every weekend with nice weather. They were using the yard. Kids were playing over there. I mean, they were there often.
And they had tens of thousands of dollars worth of receipts from Home Depot that basically spread out every week that they own the home, doing all the repairs, doing most of it themselves. Substantial improvements were done, staining, painting, sanding, fixing, nothing crazy, but all that decorating had been done. House burns to the ground. Goes to a statement, we get a reservation rights letter, we get a demand for an examination under oath, which is a high-level deposition, basically. It's worse than a deposition legally, but they're
A lot
going to
less
grill
rules.
these people.
Yep, a lot less
Give it to
rules.
Anthony to represent. They need counsel for that. Anthony represents them. It's during COVID. Nothing. I mean, this thing is at a stall.
We have to reach out to the defense attorney. It was, months and months were going by. I was reaching out every other week, especially because of the relationship that she has to this company, trying to push the carrier's attorney for a response. They weren't doing anything. And it's so frustrating for Samantha, and I was talking to her about this. I said, look, they do this on purpose. I explained all the things that you guys know about why they delay claims and all that stuff. And I finally get the attorney on the other phone, and we have a sit down. It's an attorney that I know, luckily, because doing this, I know pretty much everybody. And we talk about all these issues of what the carrier's thinking. And he says, look, they're leaning towards a denial on this thing. They don't think there's the residency provision. They don't think there's enough construction. They're not there. All these things are coming up. And we spend almost an hour on the phone of me explaining to him why he is dead wrong. Ultimately, they paid the claim. It's still being adjusted, but they've accepted coverage now, and she's in a position where they're going to be able to get this dream home finally repaired, simply because Bill and I are able to work together and get these claims done the right way.
They actually sent a couple $100,000 over to get payments moving. She'll be able to pay off her mortgage. She's struggling right now because her husband lost her job. She's covering both mortgages. Now at least the property's on hold. The mortgage will be paid off. She still owns it, and we'll adjust the balance of the claim. But when Anthony called me, I don't think it took me 45 seconds after I hung up to get Samantha on the phone. And I said, I got good news and bad news. And she's like, you've never, ever called me with bad news. I'm scared. I said, well, then I'll give you the good news first. They're covering your loss, and the check's on the way. You should be able to pay off your mortgage. I think she cried. Went over some stuff. She goes, what's the bad news? I said, oh, there really isn't any. I just used that statement. So she left. I called Lori Fantini. I'm joking up almost. I called Lori. She cried on the phone. I was like, Lori, calm down. It's just, she cried. I was like, that's what we do. That's so awesome. I love Lori beyond belief. So it really meant a lot that it was for Lori. Anthony said the same thing.
That's why we do this, guys. It's those
Yep.
moments that really keep driving, at least myself, forward with this.
Lori called me 30 times in 13 months, I'm guessing, to ask me for an update on that claim, and all I was able to say is it's still in that process. So it just felt so good. It really did. All right, take a look. Here you go. 5% deductibles on a $500,000 house. That's $25,000 there on the end. Oh, no. Normal deductibles, $500, $1,000, $2,500. When you have 1% deductibles on that's $5,000 there, right? That's $10,000. That's $25,000 when you do the percentages. Normal deductibles at the top, percentage deductibles at the bottom. Seriously big numbers. You really want to avoid that. You don't want your client to do that.
And you've always got to remember with these percentages, people use percentages when they want to make things generally sound either larger or smaller than they actually are. That's why percentages come up all the time. You can use percentages to say almost anything you want, and you can make it sound like it's some astronomically huge number or some astronomically tiny number. So they know that when they say it's only 1%, they understand what they're doing. They are trying to manipulate these insureds to thinking it's some great deductible because you're now saving money, and it's only 1%.
Here's a typical State Farm claim scenario. This is typical. $10,000 in building damage. That's a substantial claim, right? $10,000 worth of damage to my house. $2,000 worth of depreciation. $1,000 in PWI, which will be items they don't agree to pay for until they've been replaced. 2% deductible, $500,000 home, net payment zero. That's a normal claim scenario now. That is not a fantasy. That is not something crazy. Same example. Oh, the same different slide.
Yeah. So with the real quick on the paid when incurred, I want you guys to know this because we're starting to push back. I've got a claim, paid when incurred damages that we're suing over $400. I'm filed suit for $400. And the reason I did it is the carrier, and they've recognized this, and they're going to pay not only the $400, but they're going to pay some attorney's fees on it. They recognize that they cannot really change these policies, in my opinion, to a paid when incurred. Policies are not meant to be reimbursement policies. That's not why we have insurance. So we've started building a file now at my office to actually file a large claim against these carriers to get the policy changed from paid when incurred. Because
Paid when incurred is not in the policy.
No. Well, who put it in? Someone put it into the policy.
Just recently?
Yeah, very recently. Selective? It might have been Selective. Yeah. And we're putting this together because not only are we going after them in the courts, but we're actually going with them with the legislator and the insurance department. There is few things other than State Farm, because everyone in this room should know how much I hate them. There are few things I hate more than paid when incurred, because it's absolutely ludicrous to ask these homeowners who are paying your premiums every year on a regular basis to come up and have to front money that they don't have simply because you're slipping in coverage. It infuriates me.
So remember when we talked about broad and changing definitions? They actually changed the definition of a building structure. You wouldn't think that's possible. But in this case, they actually said that a building structure means a structure which building is fully enclosed with walls and a roof. A roof or wall that does not include a roof or wall does not include a temporary roof or wall structure of any kind or temporary tarp, temporary sheathing, or other covering unless it has been installed temporarily due to recent damage covered by this policy. So, if you're doing a repair on your roof and you pulled it off and put a temporary tarp or temporary sheathing on, and a huge storm comes in that night and causes damage, that is not a building structure any longer.
You know, I hate this language. This is absolutely terrible. It leaves so much gray area to the loss. What if you've got a deck on the back of the property? Is that part of the building if it doesn't have a roof on top? But one good thing that came out of this is I got to use this language. We had a case against a carrier for a large hotel up in Gettysburg that had a tarp put on top of their property after a loss. Tarp blows off, causes additional damage. The claim went from about $300,000 to about $5.5 million. Carrier obviously is not paying anything on the loss actually, but they fought in the court saying that the tarp was not a roof. And we fought back and we won. And one of the things I used was this language to say, look, even insurance companies are recognizing that a structure that has a loss where a tarp is put on, it acts as the roof of the
So
property.
Anthony used this against another insurance company to say that if it was a tarp, it had to be covered because even the shittiest policy out there covers it. How do you like that language?
Yeah.
Believe it or not, why we're doing this for fun, you can use marketing campaigns and ads against insurance companies to win.
Oh, yeah.
So if you go to the marketing campaigns that are on TV and you say, wait a minute, this kind of alludes to coverage for that, I think it was the Progressive original ads that came out that basically stated that you get brand new contents if you have a loss, saying that there was no depreciation. We had a case where they took $40,000 in depreciation on personal property, and we showed them their ad, and it said, I get all brand new stuff. And we literally got the $40,000 waived with showing, we played the video. And they're like, you're right, it says you don't have to have all this crap that they're talking about with depreciation.
If you guys ever need some of this ammunition, my office and myself in particular, I save so much stuff that I've used in cases. Liberty Mutual has those commercials where they stand in front of the Statue of Liberty, it's a green screen, but in front of the Statue of Liberty having these things. And one of them is this woman who comes in and says, oh, you had an accident? Did you read your policy? And, on page X it says XYZ. It's like, no, you didn't read it. To you it just says blah, 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 blah. And the commercial was hilarious, but I used it against Liberty in a case because they denied a loss saying, look, you had the policy, you should have read this policy when you purchased it, you knew what you were signing up for. Because my client's defense was, this is not what I was told, I had no idea this was in there. And they said, doesn't matter, you should have read it. I played that video where Liberty is saying, oh, you don't even read your own policies? They know that they're not reading the policies. We got the full award.
And there's like, what's the legal principle for that, where you can use advertising? I read it somewhere before.
I don't know. If there's a name for it, I don't know it.
I just heard, I was like, it was really cool because I saw a case where they brought in the marketing advertisement. I was like, I'm using that forever. Here's the GRC language. Basically says 5,000 or more, notify us 60 days in advance. We went over that pretty well. Here's that marring definition we talked about. The marring definition, it says disfigurement, blemish, discoloration, weathering, stretching, or the like, or to covered property, including but not limited to scratching, chipping, cracking, scorching, denting, creasing, gouging, fading, staining, tearing, oxidizing, blistering, or thinning, whether occurred at once or over time. That's a pretty broad definition. That says just about any physical damage that occurs to a property would-be mooring.
You know what's crazy about this is that this provision is preceded by the anti-concurrent causation language. And what the policies say is that if your loss involves this in pretty much any way, shape, or form, your loss isn't covered. And carriers will try and rely on that language when denying a loss. But what every carrier seems to ignore is that ensuing loss provision. I need to really stress this. Anti-concurrent causation is not some blanket ability for a carrier to deny a loss. They've got the ensuing loss provisions. Not to mention, when it comes to things like the mooring, if someone can point to me a water loss that doesn't involve staining, I'll be very, very impressed, because every single one does. These provisions are not applied on a regular basis to what they say. It only is what they want it to mean. So we can use that against them. I've used this constantly. Prior losses that they've paid that involve staining or scratching or gouging or tearing. I mean, when a shingle tears on the roof.
Denting, chipping, cracking, they're all covered losses.
Hail damage, everything. This is an absurd provision, and we use the times that they do cover it against them to make sure that they don't get away with this stuff.
You've heard about the famous bleacher case? Aluminum bleachers? They had a cosmetic damage exclusion in the policy. They said the bleachers still function fine, but they had a bunch of little dents in them. Bleacher sets about $100,000. They're pure aluminum. The winning argument to win the bleachers was that your butt would not dry as fast because the dents would hold more water. That became physical damage, but it's beyond cosmetic. It was a tough argument.
Will hold up in court.
Oh, Don, where you at, Don? So Don actually put this in a status, no slope for you, Don wrote. And yeah,
Your
so it got us
stuff
in
will
trouble, I
hold
think,
up
didn't it,
in
Don?
court.
No, you're all right.
But I don't have.
All right, here's a really tough one.
There is the
They changed the definition of an insured.
$1,500, which I
Means
paid him first.
you
I don't see it here.
means A, you be permanent residents
We
of your
make up
household who
another
are
contract.
your relatives or other persons under the age of 21
What is we
in the
make
care of any
up
person
another
described.
contract?
What does
He's
it say
not here
about
to sign anything.
permanent
We'll just
residents of your
scribble his
household?
name.
You can't
Permanent
do
residence
that.
is not
Yes, you
this general standard.
Nope.
For
It's you
a
and your
deed
spouse.
to be
So the new
filed
residency
properly,
provisions, there's actually a coverage cap on residency.
it has
There
to
is
be
15 ways to
signed
lose
by
coverage
the
based on how you live in your
original
property.
owner of the
If you go to a
house.
nursing home, you may void this.
and we don't know
You may
where
no
he
longer
is.
be a resident of your
But
property. If you're under
there
care
is
from a
a
family
new-
member, you may void this. These residency provisions can really risk coverage, and they're working on this immediately because it's national, the residency issues.
If you guys need a good excuse to do the next Lunch and Learn for us, the next Lunch and Learn I'm doing at the end of the month is all on residency premises issues. So it talks about entirely how to present claims based off of what the residency of the home is, how to present it the right way, in an honest way to make sure that there is coverage for this.
They've removed the innocent spouse provision from most policies. If you don't know what the innocent spouse provision, it says, if I come home and my wife found all my girlfriend's stuff stuffed in the back of my closet, she probably took everything out, put it in the living room, and burnt the house down and left. I'm sure she took her stuff and the dog with her. The innocent spouse provision used to say that if I had nothing to do with burning my house down, I actually got half the policy. Now it says that if any insured burns the house down or commits a loss, no one gets paid. Here's the problem with that. If you go back to the definition of an insured, it says no insured is entitled to coverage. Who is an insured in your house? Someone in the care of you. That means foster children aren't insured. If you have a foster child, it gets pissed off at you, has a troubled life behind them, they burn the house down, technically this policy has no coverage for anyone because that was an insured that burnt the house down. This becomes very risky with Airbnbs that actually may be classified as an insured if there's a minor and they're there long. It becomes difficult coverage when you have a relative in the care of you. Let's say your friend or your uncle went to jail or somewhere, rehab for drugs, and you took care of their child. They're now going to become an insured under your house, and they do something to cause damage. You may lose your house based on this language. The innocent spouse provision is a really big deal to lose, and this took it away. This is even in the ISO form, by the way, which is generally relatively broad for coverage.
There's a nice thing, real quick on that one, real quick.
That was actually in the ISO forms, which is a lot of policies.
A lot of them. Real quick on that, just so you guys know, there's a great word in there that you can sometimes use to help. Intent. The word intent is in there because you could have a loss where someone doesn't realize what they are doing is going to cause a fire. We had a lawsuit where an insured, in essence, lost their mind and burned the house down. They thought there were snakes under the bed and that they were going to use the fire to get rid of the snakes. They did not intend to burn their house down. They intended to get rid of the snakes. We were successful, got a full payment on that loss. So if you can make that same argument for those foster children, if they're young, can't form intent to burn a house down, you can use those types of arguments. If you ever need that, let me know. I'll be happy to provide the arguments.
I had a house burned down with someone trying to defrost frozen pipes. They had to burn the house down because they were heating the pipe with a torch and it got out of hand. And then they went in the garage to put the fire out and they picked up a bucket that he drained the gas tank from his motorcycle into. He lit the whole house on fire. Then he lied during the original inspection and said, no, I didn't do anything. And I'm like, they're saying you threw gas on the fire? And I'm like, it's okay if you threw gas on the fire if you didn't think it was gas. He goes, well, I didn't. I drained my motorcycle into the gas, blah, blah, blah.
I got to say this, that we're running low on time. Real quick, because it comes up all the time. If you've got a frozen pipe claim in an all-risk policy, most of the time, I'm actually recommending to people not to report it as a frozen pipe unless the plumbing bill is so astronomical that you really want it. Because if you don't report it as a frozen pipe claim, you just say it's a burst, it then becomes the carrier's burden to prove it was a frozen pipe and then prove there wasn't heat. It comes up all the time, this heat
Frozen
issue.
pipes are an exclusion in the policy.
Yep.
They're an exclusion that has a hurdle for coverage. By reporting that, now the really cool part about that as well, if you report the claim that way, you can always come back and change it.
Always.
If there was proof, but it is a way to get coverage, especially if you don't think it's a frozen pipe or we have a maintaining of heat issue. A good way to go with that.
Yeah, if you've got any heating issue at all, you always should report it as just a broken pipe, not a frozen pipe.
Let them disprove the claim.
Yep.
Overhead and profit in this policy, only if it's enforceable by law of the jurisdiction the loss is in. It's written right into the policy. Matching, the undamaged matching endorsement, so it's listed in there. They talk about we don't pay for undamaged materials, which is basically a matching endorsement. We talked about the access. Here's the $2,000 restriction for tunneling. PWI, so you're going to get an estimate that looks like this, that shows this amount of money right here. Where's my PWI? Right here. Where's PWI? Why am I missing it? Last general contractor. Where is it? Where am I seeing it?
Right here. Total maximum additional amount available if
incurred. Here's my PWI, $2,829. And that's, my guess is they're calling that entire portion PWI.
Do you know how many people don't have $2,800 just sitting around that you guys represent? A lot of them.
I had it when I left for here, but I've been gone for 3 days. It won't be there when I get home.
Yep. The DOI doesn't accept it. The DOI doesn't have the manpower to review all the policies. They simply post them for comment and review, and as long as nothing comes through, they get passed. So there is no actual way that they're reviewing these policies. I've subpoenaed them in a number of cases, and they've admitted that they can't review these. They have no idea what these policies say.
Keep bringing it up.
Yeah. Yes, as soon as a contract is signed with a contractor, the cost has been incurred because they've got to comply.
Incurred is not paid. It is a little lower standard. A signed contract does allow for it. So I agree, but when you look at some of these policies' definition of an insured, if they're in the care of others, and then if someone has let's say they've been there for 2 months, right? They may be considered in the care of others. Airbnb would probably still stay outside of that, but with people renting out their policies, Airbnb, there's tons of stay exclusions. That's actually in the gap coverage review. So if you are Airbnb, most likely you don't have any good coverage either. But these residency issues do start to apply with everybody.
Is there any company that writes a true ISO form?
ISO writes a true ISO form. But it's also been changed over the years.
Right, no, what is there any carrier that still uses just the true ISO form?
Some of the mutuals do. I see pure ISOs. Lemonade. Lemonade uses straight ISO form with no modifications. By the way, real quick on ISO, we are done for today. You can start bringing that music up if you got it. You'll notice at the bottom of some of these policies, it'll say contains ISO. That is not an ISO form, unless it says copyright ISO, not contains copyright ISO. That means there's little bits of coverage with inside there.
All right, guys. Look,
We're all done.
We are done. Don't forget, tonight, we've got a nice pool party
And
where...
Anthony's picking up the check for drinks all night at the pool, so that's a big one for you.
Yeah. I better see you guys all there.
Thanks, everybody.